Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Since 1974, one of the most popular and primary retirement planning vehicles used by investors was the IRA, or individual retirement account. Then in 1978 came the first 401k. Now, 401ks are arguably the most popular way for investors to save for retirement, with nearly $7.5 trillion in assets. One of the primary benefits to these investment accounts is the tax deferred growth and pre tax contributions. Well, today we're going to talk about IRAs and 401ks and the taxes that come with IRAs and 401ks. And is it time to rethink how we use them in retirement planning? Well, I have on the perfect guest on to discuss the merits of these two retirement strategies. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. Okay, enough from me. Let's move to the star of the show. I'd like to give a very warm welcome to Ed Slott. Ed is the president of Ed Slott and Company and author of the Retirement Savings Time Bomb Ticks Louder. Ed, thank you so much for coming on the show. It is such an honor to have you on, and a show that I've really been looking forward to for some time. Can you please tell us a little bit more about yourself and Ed Slott and Company?
Yeah, well, thanks for having me on the show. And I was asking you before we started, why do you call it wealth adjusted for risk? So you've got the right guy for that. Just a different kind of risk, tax risk, which is what I've been dealing with. You asked about myself. I've been a CPA, I hate to say it, over 40 years. So I'm still adjusting for risk. It never ends. But you made a comment there earlier. We just passed the 50th anniversary of ERISA, which you referred to, which that gave birth to the IRA. But the IRA was just an afterthought. They threw that in at the last minute.
Okay.
It was on Labor Day, 1974. It was one of the first major bills signed into law by then new President Gerald Ford. He took over when Nixon resigned. A very historic moment in history, but it was due to people losing their pensions for years. There was the famous Studebaker case, and people worked for companies for 30, 40 years. They declared bankruptcy, and they said, well, too bad, no pension. So Congress finally got around to doing something about it. And the whole ERISA, the Employee Retirement Income Security Act, was to protect pensions, which basically no longer even exists now, pretty much, because they morphed into 401ks. But as an afterthought, they brought in the IRA because they still didn't trust companies to protect employees' pensions. So somebody, and according to some books, that was Ralph Nader of all things, he said, you can't, he's a big consumer advocate, still going at it today.
Yeah.
He chimed in and said, we still can't trust these companies to protect employees' pensions. Employees should really have their own individual retirement account. And Congress said, "Ooh, that's a good idea." Yeah, he said you could put it in your IRA, then you own it, and then companies can't take it from you. That was the birth of the IRA, but it really didn't catch on until many years later. So many years later, it morphed, the whole pension system morphed into 401ks, as you said, in the late 70s and early 80s. Well, now we have a new generation of people, the first generation of people coming out, retiring with accounts, with money. They didn't have accounts before. They had that old thing called pensions.
Yeah.
And if people don't remember what that was, it was a check they gave people for absolutely nothing. They sat home and got checks, and it was a great deal until somebody came to the big companies, as you said, in the late 70s and say, Mr. Corporation, how would you like to find a way to transfer the risk and responsibility of saving for retirement from you and your company to your employees. Let them deal with it. Where do I sign up for that? And that became the 401k. So now we have this new generation of people with huge balances, as you said, in their 401ks will eventually, and here's where it comes full circle, come back to IRAs when they go rolled over. So IRAs are where the money is. So I was a CPA doing regular taxes, tax planning and things early in my 20s and in my 30s, but it hit me back then. What am I doing? Because every year I would sit at this desk, believe it or not, we've been in this office. I almost hate to admit it. This is last May was our 44th year here.
Wow.
Uh, at this desk, clients would sit with me, and every year I would tell them, I'd give them the same story. I look at their papers and say, oh, you know what you should have done? Oh, look at that. We could have done that. What this whole woulda, coulda, shoulda. And the client would say, well, what can we do about it? I said, nothing. The year ended. It's not like we have a time machine. And this went on year after year. So early in my late my 20s, early 30s, I said, this is no way. You know, tax preparation is way different than tax planning. Tax preparation, as many my CPA colleagues do still, and sorry to say, most CPAs are really that are just doing tax prep are really just history teachers. They do what like I used to do. They tell you what already happened. Well,
Mm-hmm.
what good is that? So I realized there's a bigger picture here. Instead of looking backward in the rearview mirror and putting numbers on a paper that already happened that I can't change the outcome, why don't I look forward and do tax planning that's a lot more valuable to people? And then I morphed into the estate planning, then IRAs, made their big splash, even though they were around. They started actually in 75. RISA was in 74, but the
Okay.
first IRA became effective in 75. But it wasn't, and this is another funny tidbit, they really threw that IRA stuff in there, but they had no plan to get the money out. They just said you could put money in because they didn't exist. Nobody's taking money out.
Yeah.
It wasn't until the Tax Reform Act of 86, I was 32 then. That was the watershed event. That's when all the rules for the distributions, the things that I spent my career studying, came out. And I realized I made a bold prediction then. At 32, again, I had that focus of looking forward. I said, you know what? These IRAs, all these rules, my bold prediction, I said, in 30 years, anyone still alive will be 30 years older.
That's pretty bold.
Yeah, I
Uh,
went out and it
That
turned
was
true. But what I realized when I saw all these rules, I said, these rules they're not even written in English. How's anybody? And there were pages and pages of these rules. And I said, nobody's ever going to understand it, but it's going to affect everyone in 30 years when they come to take their money out. And I said that was when the light went on, the epiphany. People always ask me, what was the moment? That was the moment. In fact, that 86 Tax Reform Act was such a big deal. It's not like today. Back then, it was a big deal when they had a tax act. Today, they have one every 2 weeks, and then the IRS changes the rules all the time. It was such a big deal that after the 86 Tax Reform Act that was under Reagan, they renamed the tax code. They renamed it the Internal Revenue Code of 1986. The former name was the Internal Revenue Code of 1954. That's what a big event that was. That's the year I was born. Yes, if you're doing the math, I just turned 70 this year. That's right.
uh,
So that was the big event. I was 32 then. I said, this is where I want to be. This is where you could save people. You talk about protecting them for risk, save people a fortune in taxes on their retirement savings. So I got into this. It wasn't even a genre of tax planning yet. It was like the emo of IRA, it's like this depressing stuff. I only mention that because one of my kids was into that stuff, and I used to say, I don't want to hear any depressing music. You know what I mean? I'm from the '60s and '70s. I want to be up and pop and
yeah.
have fun. And anyway, but that was like the emo of tax planning, and it became a genre, and it's still, I think, one of the most important specialties for tax planning, but still not enough people do it. We train, as you know, financial advisors on this all over the country. We've been doing that for well over almost 30 years already. And the rules change so often. In fact, we have a big program coming up in a couple of weeks, our 2-day program. And we just had one in July. We had to rewrite the 400-page manual just from new rules that came out in July. I mean, they're constantly changing. It's so complicated now. So anyway, that's where I morphed. I went from a regular CPA to a planner. And then a few years back, I gave up the retail CPA practice and went full time. Our company, as you know, does training for consumers and advisors all over the country. And we feel we could reach more people that way, because every advisor that trains with us, that could be 200 or 300 people. That guy can save a fortune in taxes. So you talk about risk on your show. You generally deal with investment risk, but you know what? I don't care how much you make in the market. You can make 30% a year for 30 years, right?
Yeah.
Who cares if you lose it all on the way out to taxes? All you've done is built a savings account for Uncle Sam, and it's not necessary because you don't owe Uncle Sam anything. In fact, I don't know if you know this, he's not even your real uncle, okay? There's no obligation to over.
Everything I've learned in my nearly 50 years, you just threw out the window.
So now we're into all of this, but now I see bigger problems on the horizon. That's why I call my book The Retirement Savings Time Bomb Ticks Louder, because I'm worried about this liability accruing, these big chunks of taxes accruing in people's retirement accounts, but they don't see it. It's like they're living in a house that's ravaged by termites, but the house looks fine until it falls down. And yet they want to imagine you had a house that was loaded with termites, and you say, you know what we should do? We should put more money into this house. We should build another story, maybe another story, go out, build a den. The whole thing's crashing down. Why would you pour more money into? Because you didn't know there were termites there. Same thing with your IRA. I've had clients over the years. I remember one of them, but it's happened more often over the last few years, where they come in and they've hit the $1 million mark in their IRA or 401k. In fact, you saw about a week ago, Fidelity put out a report, more 401k millionaires than ever before. And I remember this one guy, he came in, he brought me a statement. They left it there. He said, Ed, look, I did it. I have $1 million in my IRA. And I looked at it, I said, what is this? What are you showing me? This is not yours. This is just temporarily on your letterhead. You're not keeping any of that. Half of this is owed right back. Here, let me change the title. I've had his name there, and I said, let me add Uncle Sam IRS as the joint owner, because that's what it is. Your IRA is an IOU to the IRS. So you said we have to rethink things. So I'm going to say something like I said 30 years ago, my big bold statement. I think people should stop contributing to IRAs and 401ks because it's full of termites. The taxes, all you're doing is giving more money, building up more of a savings account for Uncle Sam. Now, people are shocked when I say that. They say, oh, you're Mr. IRA all these years, and now you say don't put money in these things anymore. Right. Because I want you to have more later. You got to think long-term, big picture. So that's really my focus right now, especially how complicated it's got to just take your own money out of your IRA. It's bizarre.
Wow, Ed.
Well, that's my intro.
Okay, I don't know. I don't know where there is so much there that we could talk about. I absolutely love it. First of all, let's talk about you don't look a day over 50, number one. And I'm assuming based on that intro, you don't have to worry about RMDs here
I
in
don't
3
know.
years.
People say, you know, Ed, you're going to turn 70. Well, it's not 70 and a half anymore. It's 73. But that means nothing to me. I don't have RMDs. All of my money is where I tell people to put it, in a Roth or in life insurance, tax-free vehicles. I believe, really now it's the best place to be, because I say it in every one of my consumer programs. You need to start moving your money from accounts that are forever taxed, tax deferred, to never taxed, tax free. I'm a big believer in tax free. And I'll tell you something else. I do seminars all over the country for consumers. And even in the height of all this political rhetoric and everybody's at
Yeah.
odds, everybody loves my stuff. I mean, I think I could bring America together. When I say tax-free is the way to go, they say, yeah, tax-free. Doesn't matter, Democrat, Republican, everybody wants to save taxes. So that's my slogan for America. Tax-free is always better.
I
I get
love
100% of support.
I love it. Sign me up as your running mate. Although I won't be able to help you, I'd probably detract from your chances, Ed. But I love it. So you brought it up. The next question I was going to ask was about, if not IRAs and 401ks, then where? Where should, and you mentioned the Roth.
Roth,
Why? And again, you commented on, but why is a Roth so much better than a traditional IRA or 401k?
I'll give you a hint. 2 words, tax-free. I love tax-free. Everybody loves tax-free. If you ask somebody in retirement or heading there or almost there, would you like a taxable retirement or tax-free? I mean, tax-free is always better. It's one of my always rules.
Always.
I mean, but there's no question that the Roth is the single best retirement account to own. No question. The only question is, how much are you willing to pay to get it?
Mhm.
That's all it comes down to. And that's where the rubber hits the road, because people say, yeah, I'd like to get it, but I don't want to pay for it. Well, it's not a choice. You're going to pay. It's not a matter of if, but when. And
Mhm.
when should you do it? Right now, while taxes are historically low. And for those of you who don't realize it, because everybody complains about taxes, but
Yep.
the are the good old days. Now's the time to strike. In this book of mine on page 28, and I put this, I know you might not be able to see, but I give
No.
the history of tax rates from 1913 up to now, 2024, just as a comparison. And just to pull out a few years, the years people like me and probably many people watching this were born, the baby boomers,
Yep.
1946 to 1964, just as a comparison to show you how good you have it now. The top federal tax rate for each one of those years exceeded 90. 90. Did you hear that? 90. 90. No, don't switch your dial. It's not static. 90%. Except for the last year, 1964, when they dropped the top federal tax rate all the way down to only 77%. Now, I was only 10 years old then, so I was watching the Beatles on Ed Sullivan at that point, but I heard from people who were around, they said the whole country did a happy dance. Only 77% top rate. What a deal. Now the top rate is not even half of that. This is the key to saving the most in taxes, and it's my second always rule. The reason I have all these always rules, you see people all the time on TV, not me, but they're wishy-washy. They can't make a statement without, weaseling. Well, could be, probably, maybe. It depends. You never know. I have certain always rules. My number one always rule, tax-free is always better, no question. Things that are non-negotiable, always true, you can take to the bank. The second one is the way to save the most money in taxes, always pay taxes at the lowest rates, especially on IRAs. You might not say that about other assets, non-IRA assets, because you might say, why pay it all? If it's not in an IRA, I get a step up in basis for my kids, but that doesn't happen with an IRA. With an IRA, you or your beneficiaries will pay the taxes. So it's not if, but when. But when? So as long as we know they're going to be paid, why not get them on sale? There is a sale on taxes now. Look what people do on Black Friday or whatever that
Yeah.
is, after, they trample each other to death to get $10 off on a TV. The sorry thing is with that, hate to say it, you don't actually have to buy the TV. But
Mm-mm.
with the taxes, you do. It's not if, but when. So as long as you know you have to, somebody's going to pay, because that's the deal we made. From the first dollars we put in the 401ks or IRAs,
Yep.
you get the tax deduction, but you're going to pay later. Well, now is later. So we know it's going to be paid. So why not get taxes on sale? So one of the ways to do that is start trimming down these large growing IRA balances, moving it into Roths. I'm not saying do everything. Actually, I am saying that, but not everybody can do that. So maybe a good plan over time, do a series of smaller Roth conversions over time. So over time, you're taking down your horrible, lousy, tax-infested IRA and building up in the promised land. Roth IRAs where everything grows tax-free and you never have to take the money out for the rest of your life. And even under these new, more harsh rules that came out, even your beneficiaries can hold it for another 10 years,
Mhm.
accumulating tax-free. In other words, once it's in the tax-free territory, that's what I call the Holy Grail, the promised land, that money grows 100% for you. No more sharing with the government. When you show me, like the guy who showed me a statement, when you show me
Yep.
a Roth statement, like when I look at my own Roth statement, I feel pretty good. Wow, that's all mine. That will never be taxed because I paid for it many years ago up front. And that's what I'm saying people should start doing. And if anything, stop adding to the problem. So what do you think people say, especially accountants, to me when I say stop adding to an IRA or 401k? They say, but the deductions.
Uh,
Oh, that is short-sighted because that's what I did years ago when I was still looking at 1 year at a time. For
Yeah.
tax planning, you have to look at your whole life and beyond. How much taxes can you save for the rest of your life and for your beneficiaries? That's what you're paying for up front. You're paying for what I call tax freedom. I call the
Mhm.
Roth tax insurance, right? It's insurance against the uncertainty of what
Yeah.
future higher taxes can do to your standard of living in retirement. That's why I call this book, The Retirement Savings Time Bomb Ticks Louder. I'm worried about future higher taxes. And as a CPA, I guess I have to believe in math. Congress doesn't, but I have to believe in math. And I'm worried about the debt levels. They're 35
Yeah.
trillion, I think now.
Yep.
Debt is bad when Congress now rounds off to the nearest trillion. That's not good, you know? And that's what they do. Well, 34, 30, I just said it myself, 35 trillion, nearest trillion. I used to say our debt level was a phone number, but now it's bigger than a phone number, even with the area code and the one. It's even bigger than that. I mean, so I have to believe at some point either Congress is going to do what they've been doing, kicking the can down the road,
Yeah.
or print money, or I don't know what they're going to do. At some point, they're going to have to raise taxes. And you don't want to be there when the music stops. Because who's going to get caught in the soup? The people with the most money that has not yet been taxed. That's everybody piling into 401ks and IRAs. So that's what I'm worried about.
Such great advice, Ed. I love it. There's that saying, there's only what three certain things: death, taxes, and whatever the third one, Wisconsin Badgers underperforming in football.
I don't know. I didn't know there was a third one.
Yeah, whatever one you want. But usually mine pertains around the Badgers not making me happy. Um, but it's taxes, right? I mean, you're gonna get taxed.
Exactly.
So
You can make a fortune. People don't look at taxes as an investment. A lot of times I'm on these CNBC shows like the Power Lunch and thing,
yeah,
and they don't know what to ask me. They don't even know what to make of me being as a guest because they're big on investments. You sit there, the big boards behind
yeah.
you, and at some point, I give, to my talk about IRAs, and they don't know what I'm talking about. So they go back onto their crutch. They'll say, "So Ed," and I love when they say this because this is when they say, "What, we're looking at the board. What should people invest in now?" Because that's all they know. What stock? I say, and I set them up good. I say, I have the perfect investment. You never even heard this on CNBC in all the years. Here's the best investment you can make. And I built it up. I say, are you ready? Are you sure you're ready? Is everybody listening on the panel here? Here's the best investment you can make. Invest in taxes. And then their head spins around like The Exorcist or something. What do you mean? What do you mean taxes? Is that a stock? No. Invest in taxes. It's like the old comedian from my era. You may remember him, Henny Youngman. He once said, I'm putting all my money in taxes, the only thing sure to go up. That's exactly what I say. Invest. If you're going to put money somewhere, buy off IRS as a partner on your retirement savings. That will be the best investment you will ever make.
I love it. I love it. Yeah, I can just imagine CNBC folks what they were thinking then. I love it. So you talked about, you know, but Ed, what about the tax deductions when you contribute to an IRA? How about what do you tell people when they contribute to a 401k saying, well, I get the match. I want to contribute up to 6%, so I get the company match into a 401k. What do you tell those people when they talk about that benefit?
Well, that's all changed. When I say go to a Roth IRA, I'd say more than 80% of the big companies out there have Roth 401k plans now. So you can start contributing to the 401k, Roth 401k instead of the 401k. But then the same question came up, what about the match? That's changed. The Secure 2.0 Act had a very good change there. It said the match can go into the Roth 401k now. So you can go all Roth. But then the next thing is this, I don't even like using the word, but that's what people call it, a deduction. To me, you know what a tax deduction is? To me, a tax deduction is something you actually get and keep. Like when you do your taxes, you might have a tax deduction for mortgage interest or charity or medical or something. You keep that deduction, you never have to give it back. The word deduction doesn't really apply. When you get a deduction, say for your 401k, which you do, you get a reduction on your W-2 for the contributions you made to your 401k. So people call that a deduction. But you know what that really is? It's really just a loan you're taking from the government that has to be paid back, will have to be, not if, will have to be paid back at the worst possible time in retirement when you want more stability and you don't even know what future rates will be.
Yeah.
Or your own future rates. So really, it's a timing difference. We call it in accounting. It's a deduction that will have to be paid back. You don't keep it. So why take a deduction? Another reason you don't want a deduction for tax planning, you want deductions when rates are high. You want to take income when rates are low. Rates are low now. Now you want the income. Deductions do nothing for you. Why take a deduction even at 37% if your future rate might be 50% and you have to pay it back and then some plus interest? But people are short-term thinkers. They think, but I want something now. And the accountants, my own colleagues, I have to say, they like I did, but I stopped in my late 20s. I saw that, I became a recovering accountant early on, especially when the Roth came around, 98. Then I was all in. But a lot of my colleagues didn't go for it. Matter of fact, a lot of CPAs said, oh, no, don't pay taxes on a Roth. That's crazy. And that's because as accountants, this is how we were trained. From your first day in college, they drummed it into you, hardwired. Never pay tax before you have to. Always put it off. Defer, defer, defer. And that was the norm. So that's how we think. In fact, if when you were a kid and your mother told you to do something and you say, not now, I'll do it later, Ma, you would have become an accountant because you were to defer, to put things off. But that's why I say I became a recovering accountant, because that game, that dog doesn't hunt anymore, or whatever you want to call it. It's just not good long-term planning to build a debt. What you're doing is adding to the mortgage on your IRA. Would you do that with your home mortgage? Oh, I have an idea. We have a mortgage. Why don't we borrow more? That's what you're doing. So that's my answer to people who say, but I get a deduction. No, it's temporary and you're going to give it back at, we don't know what rate, but it could be when you're at a higher bracket. And that's another thing people say. They say, but I'll be in a lower bracket in retirement. That never happens. I know it's my number one retirement myth. People think they'll be in a lower bracket in retirement, and they're right logically to think that way. Why? because they say, well, I make a lot of money. If I don't have a W-2 in retirement, my income will be low. Wouldn't that be a better time to take my
Mhm.
money out of the IRA? You always say get it out at the lowest rate. I said, yeah, but that's not going to happen.
Yeah.
And the reason it's not going to happen is if they do nothing. Doing nothing is not a plan. If you do nothing, the IRA doesn't stop growing. It keeps growing.
Yep.
The problem gets bigger and bigger. So when you retire, you may have no W-2, but then you're forced to take money out at age 73 now. And for many people, if they've saved a lot and have larger IRAs, their RMDs, required minimum distributions, will dwarf their W-2. I had a guy years ago. I told this to him I told him to do Roths for years and years. He came
Mhm.
in, he said, nope, I'm making a lot of money. I'm going to be in a lower bracket in retirement. So this went on for years. Finally, he comes in to do his tax return and he's all excited, because it's his first tax return in retirement with no W-2 at all. So he thinks he's going to make out like a bandit. I give him the return. He says, Ed, how could this be? My income's higher than my best earnings years. I said, how could it be? Because you never listen to me. That's why.
Yeah.
And now your IRA is so large that, yes, your RMDs, which you're forced to take out, now it's out of your control,
Yep.
is larger than your
Yep.
former W-2. Not only that, people in retirement, that's the income side. So I
Mhm.
think for most people, if they have large W-2s, they had a nice job and everything, because those are the people that think, well, I've been making 3, 4, 500,000 or whatever. So if I take that off my return, I'll have low income in retirement. But what they forget is those are the very people that probably maxed out their 401ks and IRAs
Mhm.
and have $1 million IRAs that are going to throw off these large taxable RMDs that are out of your control. So that's on the income side, but they forget about the expense, the deduction side. Retired people have less deductions. Most retired people don't get any more tax benefits for dependent children. Most retired people have paid off their mortgage, so there's no mortgage
Mhm.
interest deduction. Most retired people are no longer contributing to a 401k, so there's no deduction there. And most of them now, with the rules for the last few years, are taking a standard deduction. So now you have a situation in retirement where you believed you'd be in a lower bracket, where your income is higher for RMDs and deductions are lower.
Mhm.
What does that add up to? More income at we don't even know what future rates will be.
Yeah.
I want to back to your show, wealth adjusted for risk. I mean, I want to adjust your retirement savings for risk, and the
Yep.
tax risk may be the biggest single risk in your portfolio.
I love it. I love that you keep on bringing in the title of the show, number
Well,
one.
I saw it. I said, this is great, but he's
Yeah.
probably not talking about the risk that I'm talking about.
But you're so spot on. I think tax planning for investment professional financial advisors is getting more front and center. You say more, but it's still not enough, right?
Well,
Because it
because
is a huge risk.
they say they do it, but most of the money for most people now is in retirement accounts. You talked
Yeah.
about the trillions up front when you were introing the show. I think it's like 25 trillion if you add the IRAs.
IRAs. Yep.
Yeah. That's where most of the money is. So people that say they do tax planning, they're doing planning in their non-IRAs. They're harvesting gains and losses and capital gains and all that stuff. The big money is in the IRAs, and most advisors are not familiar with these complex rules of getting the money out. And that's what we do. We train advisors, but not enough take the training because they're not really trained. They don't want to know it. When you talk about these IRA rules to them and tax planning around retirement accounts, it's like kryptonite. I
Yeah.
can't, I can't.
Yeah. That's fantastic. In my previous life in this industry, gosh, early 2000s, mid 2000s, I worked for a group where advisors to plan sponsors. And it was mid 2000, and we had just started rolling out the option to do the 401k Roth. And it was interesting. It was a slow adoption, right? Some companies took it, some others. So I thought that was great that you brought it up, and I'm glad to hear that more and more companies are doing it. I love it. Also, I'm going to end with this. I
Are we
can't
over?
believe it's already the
But
third
I'm just
quarter.
warming up. What
I
is it?
know, right? I'd love to have you on again. We need to schedule more. I just love it. I love it. And I love it more when we can just talk and I can just sit here and listen to somebody with sharing such great knowledge. I can't believe we're already getting to the end of the third quarter, middle of the third quarter. So now I'm assuming is a great time to start tax planning. Reach out to you, Ed. I'm assuming for all of our listeners to help with that tax planning for this year, so your clients are better situated um, for come tax season.
I
Thank you.
will put one warning on this. I talked all about Roth conversions, but one thing advisors should know this, but just in case they don't, Roth conversions that changed in the Tax Cuts and Jobs Act, if you remember a while back, are permanent. Once you convert, you will owe the tax, even if your financial
Yep.
situation changes over time. You will owe the tax. That should not deter you from converting. But I would have the conversations. You talked about advisors talking with their clients. I would have the conversations now, but I would not pull the trigger on the Roth conversion until the first week in December, when the mutual fund companies throw off the capital gains, bonuses may be in, and you have a better idea of what it's going to cost. So you can do better planning using up these low brackets.
Awesome, Ed. Thank you so much for coming on the show. It's really been such a pleasure to have you on. I love it. I would love to have you on again to talk more. Thank you, everyone, for listening to